Hello, everyone. This is Cyrus with Level Up Financial Planning, and today I wanted to talk to you about how to offset the restricted stock units tax impact once they vest. And so this isn't going to necessarily be recommendations. It's just going to be information so that you are aware of potential ways that you could offset the tax impact at vesting of RSUs. So I kind of laid it out in the slide for you. One of the possibilities that you'll want to do is basically once they vest, you're already paying the taxes on them at the value that they vest at. So if you sell them pretty quickly, there should be practically no additional tax implications at that point. You can then use the proceeds to fund tax-deferred accounts like an IRA, a 401k. Health savings accounts also have some tax deferrability. I think the biggest thing to be aware of with these is there's a reason why those accounts are tax deferred. It's because they have certain restrictions and rules that you have to follow in order to utilize those funds. So for those retirement accounts, typically there's age restrictions, commonly age 59 and a half before you can start pulling out from those accounts. So this only will work for those of you that are able to put funds into that account and not necessarily need them until you reach those time formats. For HSA accounts, those are going to be more specifically for medical expenses. Another thing I just want to warn you before we dive into an example is the taxes withheld at vesting actually automatically occur. So as we go through this example, the kind of final proceeds amount isn't going to be realistic just because there's the Social Security and Medicare tax that gets withheld as well as just regular federal tax that gets withheld automatically. And that's just kind of a way of protecting people from forgetting to accidentally pay the taxes on their stock options until it's time to file their taxes. So then if they underpaid, then there's a penalty for that. So that's one of the reasons why that happens automatically for you and you're not able to really do too much about it. So just know that this example is just kind of a cleaner way of presenting it, but it's not going to actually work fundamentally this exact same way as you go through the process yourself. And there's no way to avoid negating the Social Security and Medicare tax because that has to come out. The RSUs vest at ordinary income rates, which means you have to pay Social Security and Medicare. Even contributions that you put into your 401k, they're tax deferred from the federal and state side of it, but it still kind of runs through and you pay the Social Security and Medicare taxes on those contributions before they go into the 401k account. And that's why once you retire, once you start pulling funds from those, you don't have to pay Social Security or Medicare taxes on the funds you withdraw from those retirement accounts in the future. So with all those different complicated explanations out of the way, let's run through an example of hypothetically what this could look like. Let's say 100 shares of XYZ company shares vest at $50 a share. That means that $5,000 is going to be basically what the value of those shares are once you receive them. That's also going to show up on your income tax as ordinary income. But what happens if you sell all 100 shares at $50 a share? You receive that same $5,000. It's going to be sitting in cash in your account. But then you can take that cash and you can contribute it directly to a tax-deferred account. So if you contribute exactly the same amount that the taxable RSUs vested at, then basically that's going to wipe out your federal and state income tax costs basically for the restricted stock units vest. And so basically that's one way you can directly offset that. Again, it's not going to be as clean on your proceeds side. So if funds are withheld, that $5,000 isn't going to look like $5,000 when it vests and you sell and it's sitting in the cash. It might look more like $4,700, $4,600. So if you want to perfectly match that to just negate the whole tax situation, you'll probably have to contribute some out of a personal checking or savings account just to completely cover that. But it's usually negligible, a small amount, so it may not be worth it to kind of go through that hassle. So even if it's $4,700 at the end of the day, you contribute that directly. That's going to take care of a majority of that tax impact. Hope this video was helpful. Again, not necessarily a recommendation, but just one way that I've utilized with my clients in their particular situations if it called for using this type of strategy. And I just wanted to share that with you today.